Alrighty, folks, it's finally coming. We've been talking about the commercial real estate distress as an opportunity for us to get rich and get wealthy. According to CRE Daily, there is $930 billion in debt maturities in 2026. This has been somewhat delayed because of private capital, mezzanine financing, and the like. Delays, extend and pretend, stay and pray, all of that. However, foreclosure activity is rising, and the experts think there will be a surge in apartment foreclosures as 60% of the debt that went out in 21 and 22 comes due next year. Jonathan, I'm smiling. It's finally coming. The thing that I've been looking at from all of these bad deals. We're finally going to be able to scoop up opportunities, pennies on the dollar. What say you?
I mean, listen, there is going to be almost $1 trillion worth of debt coming due in 2026, a very large portion of which is multifamily. Mm-hmm. You and I, back while those loans were being issued, which is, now if you think about it, it's kind of scary that you and I have been talking this long, right? Every week. Yeah. But 5 years ago, we were looking at some of these deal structures and going, this ain't going to end well. And, but, you know, neither of us predicted the sudden rise in interest rates, but we knew that that was that rising interest rates, when you structure your debt that way, is always a risk that needs to be accounted for, and it wasn't being accounted for. So here we are, $1 trillion of debt coming due, triple the amount that came due this year, right?
That's a big number. That's a big number.
Yeah. Putting aside the fact that interest rates, as that article says, have gone up by 150 basis points, right?
Yeah.
Between what's maturing and where they can get debt right now, just the sheer volume of it means that a lot of that ain't going to get refinanced. I think a lot of it would not get refinanced even if all the conditions were better, just because of the sheer volume of it, right? And just the sheer volume would push up interest rates because of competition for that money.
Agreed.
So I think that this is a perfect storm that is about to break on us in commercial real estate, and that means a lot of pain for people who own these things and a lot of opportunity for people who are in a position to buy.
Yeah. So let's talk about that. Cause that's, again, I think I've said, and I didn't say it hyperbole. I think over the years I've said, this is going to be the greatest transfer of wealth that I've ever seen. And I think it has a very good chance of doing that. But to your point, I think there's a couple of things we have to dig into. First, $1 trillion coming due. It would be hard to absorb even if prices were flat, and they're clearly not.
Yeah.
And by the way, expenses are up, and vacancy. It's just a complete collection of bad for the existing owners. So when I look at this pile and I look at the $1 trillion, I'm like, okay, there's probably 25 to 33% of these, things that will just that will get refied because they may be low LTV, long-term hold. They didn't do an equity extraction. So, okay. So 300 million or 300 billion, excuse me.
They actually did pull off their value add, right? They actually did execute it, and they raised the value of these properties by enough that they're fine.
Yeah. So there's a third. Yeah. There's a third that get done. All right. Well, there's 2/3 that don't. And again, you just don't know, but I'm going to guess another third, they find a way to kind of, fight it out and bring some money to the table or whatever, but that still leaves $300 billion in opportunity. And this stuff's going to go cheap because the equity is completely gone. The new value is below the debt level. And the last point you brought up, I think, is the real opportunity. It's going to be hard to get money.
Yep.
And it's going to be only the operators who have really deep pockets or a spider web of private capital, because you might have to come into these things with 50% LTV or something.
Yeah.
And so it doesn't matter. You're buying it, 40 cents on the dollar, but you still got to come up with half that is equity.
Right, but
And
those values may be so low though
oh,
that
true.
the dollar amount of equity that you have to come up with is not that high,
That's
right?
true, actually. Yeah, you're
Yeah.
right.
And
Yeah.
also, I suspect that this is actually not all the property that's actually coming due,
Mm.
because this is really only like, you know, BizNow, which is the underlying source for the data for the CRE article, CRE Daily article. You know, these groups really are only tracking institutional quality
Oh, so they're at the
investments.
top of the food
Yeah.
chain.
Yeah. So, I
Oh,
mean, when
good
I say
catch.
institutional quality, I mean just larger deals. So
Yeah, yeah.
there are a lot of syndicated deals in there as well that are, you know, big syndicated deals. What this doesn't capture, I believe, okay, take it with a grain
Sure.
of salt, but
Fair
I
enough.
believe that this does not capture all of the local
That
banks, credit
that would make sense.
unions
Yeah.
that have lent on, you know, the 10 to 20 units, or like basically like the sub 50, you
Mhm.
know, the sub $5 million deal kind of stuff, which is also, those deals are also in the same situation,
I
right?
agree. I
Because if
I would
they've got,
argue that those are in worse shape probably.
yeah, I mean, maybe not, because maybe those local banks only were willing to go to 65% LTV in the first place,
It's not what I
you
was
know,
seeing back then.
really.
I was seeing stupid behavior.
So
Yeah, and they
then,
were going to 80 sometimes,
oh,
local
okay,
banks.
well, listen, then it's even worse, and there's going to be opportunity at all levels of this thing, right? So,
Yeah.
I think that that 1 trillion number probably understates the
It's
amount of
probably
debt
a
coming
double
due.
then. It could easily be a double, right? When you think
Oh,
about the quantity,
yeah,
I mean,
but
it could be.
those deals are a lot smaller. The loans are a lot smaller. So I wouldn't say double, but I don't think it captures all of it. And I think
Okay.
and I don't think it captures really any of those kind of like local mom and pops, local
Yeah.
banks, credit unions, that kind of stuff. Cause that's not what those guys are tracking.
Yeah.
So, I mean, you know, they in that article, they talk about the debt fund, how much money was raised by debt funds. Like that's the kind of stuff that they're tracking. They're not tracking, because
Mm.
JLL, who also supplied some of that underlying information, JLL is not tracking, you know, 10 to 25 unit mom and pop apartment buildings, right?
Right. Yeah.
It's all like larger institutional, sub-institutional level stuff. So this wave is going to crash, and and I mean, you know, you and I have been talking about sort of 2027 as the year, but it's very interesting that, you know, they're saying 2026, it's all coming due next year. Extend percent, you know, I think probably because so much of that debt was 3-year debt with a
Yeah.
couple
They
of
got
years of
1-in-1
extensions.
extensions. Yeah.
Yeah, and you know, to get the extension, you've got to buy the rate cap, and I'm seeing this happen. People bought the rate cap last year. They went to their investors. They got money to buy a rate cap to do the 1-year extension. Prices didn't rise,
No,
and people are like, you know what?
not doing that
I'm
again.
not doing that again. And so after 4, they're tapping out, and so that stuff is coming to market in
Yeah.
26.
Yeah. So again, let's try to play this out for folks. So again, I think this is going to follow a very similar path to how I picked up apartments last time, 50% off. So what will likely happen is I think a lot of these properties will be listed first,
Oh yeah,
right? The owners, and again, they'll be listed publicly. So, and that's going to be your first sign of distress is you're going to start to see small multifamilies. Again, that's all I play in, sub 50, and they'll be listed, but you'll see them and they'll be listed at stupid prices
yeah.
because the seller is hoping for a miracle to get all or some of their capital back to their investors and at least solve the debt problem, right? They don't want a foreclosure or a short sale. So they'll be listed. The bank will probably give them certainly 90 days, probably 6 months to see if it sells. And then things get interesting. That's what I'm seeing. What do you think?
Mm. Yeah, that scenario makes sense to me. And I'm already seeing stuff coming to market with, you know, either, and this is kind of a big sign too, because, you know, the brokers as a rule don't really want to sort of incite the panic or, you know,
Mhm.
but I'm seeing a lot of stuff come through now that's like lender driven sale, REO sale,
Ah, there we go.
um,
Yeah.
improved pricing, right? Like it's come I'm seeing a lot of, and not
Yeah.
necessarily multifamily, just other stuff that's coming through,
But it's
but
signs. There's signs that the
there's
pain's coming.
signs that it's
Yeah.
coming, right? And that that property is not moving and the prices are unrealistic, or deals falling out, right? I'm seeing deals falling out, coming back to market. So those are all signs that these asking prices are not realistic. And listen, this is exactly this is like the parallel moment to when I entered this business in 2011.
I agree.
Same point in the cycle. And what I was seeing was deal after deal after deal that made no sense at all because the asking prices were just not realistic. And then 2012, 2013 started seeing stuff like loosen up, sellers getting realistic and coming off their
So I want to poke at that word sellers, because I think at some point, and again, this is why, folks, you're going to have to get your shopping list. You're going to have to build relationships. You're going to have to be in it, because the seller is the person that the current owner is the seller who says, put it out there at wish. This is all wish pricing. This is like, somebody save me. And then at some point, a year later, 18 months later, it's no longer the seller. Now it's the institution. It's the bank. It's the financer that's forcing these price drops. So it moves to another entity. Now, whether that's gone through an actual foreclosure or the bank's just forcing the hand, those, we'll decide later. But these are going to be things you're going to have to, it's going to be like when you're fishing and you've got a big one on the line. It's going to take a while to get to the boat, because I think the first 6 months of this is just completely wish pricing and, people hoping for, miracles. Yeah. But, again, some of the best deals we got in 18, a couple of 10s, we tracked for a long time. We just stalked them and eventually got them.
Yeah. And I think, one of the things I've been talking about just so much in my group and just with people in general is the importance of knowing a market really, really well.
Amen.
Right? The days of chasing population growth to the Sun Belt are done for like syndicators. I mean, what I mean by that is syndicators are going to keep doing that. This is not a way to make money anymore.
No,
right?
Agreed.
This is not a good investment strategy for average people. If you are an institution with unlimited funds and you have to place them, and it's all about CYA and follow the crowd so you don't get in trouble, right?
Yeah.
Flock to the Sun Belt and buy stuff. But that is not going to work for anybody else, right? What you need to be doing is getting really granular about a particular market. Look, if you live in the Sun Belt, this is different, right? If you live there, then you can do this in the Sun Belt. But I'm talking about out-of-state investors. Learn a market really, really well. Pick your buy box and just focus on that.
Amen. This is the time. Yes.
Yeah.
Double down. Yes.
Focus on like one town or one county, right?
Yes.
And do not go outside that.
I love music to my ears.
Yeah. Just relentlessly focus on that one spot and learn that spot well and follow every deal in that market and just track it. And you will see in real time the price cuts and the stress.
You'll see the pressure just build.
Yeah. And more stuff coming to market and sitting there. And like, that's when you're going to be able to move and start making aggressive bids, get things for attractive prices, and really set yourself up for the next upswing, which is inevitable. It will happen.
Oh yeah.
It always does. Right. And it's you want to get in there when the getting is good. And also I want to remind everybody, I mean, I see all this BS from people, both syndicators and brokers, who are kind of like, if you don't buy in the next 6 months, you're going to miss it. And it's like, it's silly. The bottom lasts for a while. It's not a V-shaped recovery, right? It's going to take a while for people to kind of come out of the woodwork, think it's safe.
It might not even start for 6 months. I mean, come on.
Crazy. And it's going to take a while for like people who weren't burned in the last cycle to kind of like get interested in real estate and start coming, thinking that they had an original idea, like how I'm going to go invest in apartments, just like we saw when I got into it. And so that all that takes time. There are going to be a few years of pretty attractive pricing as this backlog of deals clears the market, right? It is not going to be like this V-shaped recovery, even though all these people say that because they secretly hope that that's the case. But that's not how it works.
Yeah, I just want to double down on that because again, this is I've always obviously preached buy box, know your market. But again, if we're stocking big game here, and we're talking, I'm talking 50 units and below, and you can go bigger. When you do that, there's only a handful of assets, and by
Yeah.
handful it could be 20, 40, something like that, a
Yeah.
manageable number. You got to go deeper. You got to meet the listing agents. You got to find the brokers. You got to follow up. You got to, this is the time to work your way to being one of the top 3 people on their call list.
Yeah.
And you got to show what you know, right? Again, hey, I'm calling. I like B, C class properties in Fresno, California. I see you've got listed 123 Main Street, and you've got 123 B Street, and blah 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 blah. And you got to really show what you got. Take them to lunch, go to dinner, walk properties. This is the time to do the work because again, when the big game lands, you're going to fundamentally change your life forever.
Yeah.
Right.
And
there are 2 apartments that changed our life forever. There's multiple 7 figures in 2 assets. It's crazy.
I mean, listen, and here's the thing, like people have this idea that like brokers are like looking to keep you away, or like looking to keep you at arm's length, or like looking to like, you've got to be the strongest buyer or whatever. Listen, brokers are human. They make friends like everybody else. Right.
Mm-hmm.
And when they make friends, they like to kind of do stuff for their friends. So like if you become friendly with brokers, just as long as only thing you have to avoid is making it clear that you're wasting their time. Like if you're wasting their time, they're going to treat you like a time waster. But if you're in there, you're looking actively at deals, you're discussing with them what it is you're looking for, why you're looking for that, why a particular deal works or doesn't work for you. And you just demonstrate competence and reliability and like decency.
Mm-hmm.
You are going to be rewarded because then that deal is going to come to that broker, and that broker is going to be like, you know what, this is the kind of stuff that Jonathan likes to buy, or that Jonathan's interested in, and I'm going to go show this to him. Right now, you might not necessarily be the only person, but but you
be on the list.
But you be on the list. But also, you might be the only person who's interested in that particular asset class, or that particular. You might be the only one who's like, I want to buy 5 to 10 unit properties of this age with this play, perfect condition or terrible condition or whatever it is. Like you might be the only one that they know who wants that sort of thing, but they're never going to know unless you tell them and you get to know them and just, so this is the time. This is the time.
Again, folks, what we're talking about here is getting frame of reference, a buy box, getting to know people. Again, on my 7 rules, one of them is meet 2 new people a week. It's time to double down, follow up, create a pattern, talk to them every 2 weeks, send them a note, send them an email, get to know them, know what you're looking for, show your value. Don't appear like a time waster, right?
Yeah.
And please, folks, don't just say, give me a deal. I mean, I hate that.
Yeah.
I freaking hate that.
You have to. This is one of the things that I talk about, like just like you talk about your buy box, right? It's the same idea. You've got to understand, you've got to really hone in. Like, don't make the mistake of thinking like, oh, you have to cast a huge wide net in order to get deals. No, hone in like a laser beam on a particular kind of thing that you want, because it's easier to communicate that. It's easier for the broker to remember that that's what you want. And it also communicates seriousness.
Yes. Right? Yeah, you're not playing around.
Yes. You're not playing around. You're not like, oh, give me a good deal, right? Because the broker's, well, what does a good deal mean to you? A good deal is different for everybody. What does that mean?
Exactly.
Yeah. So don't go to a broker and say, give me a good deal. Go to a broker and say, give me, 10 to 15 units in these 3 neighborhoods at this price point, right? In this kind of play, that's what helps them. Right. It helps them to know exactly what you want, not like some amorphous, like give me a good deal. Right?
No, I totally agree. This is the time, folks. Again, we've been talking about this. Probably we're a little early, but we saw it coming. We saw the deals. I remember laughing with you at some of the deals because we're both accredited investors. And I was laughing at these assumptions, like this is not going to end well. And then it got even worse than I expected. I expected pain, but I think the pain's going to be 2 or 3x bigger than I thought, just like the GFC. I sold my stuff at the peak knowing it was going to be bad, but I did not know my market was going to crash 75%.
Yeah.
So pain is coming.
And I think, the real issue in multifamily is that, in the GFC, there was like, everything went up and then everything went down, but there wasn't like this particular frenzied focus around multifamily right?
Agreed.
But
That's why the pain's coming.
in the lead up to the GFC. So it's ironic how these cycles work. Like as a result of the lack of attention paid to multifamily in the great financial crisis, it didn't crash as hard because it hadn't been blown up as big before.
Correct.
That then made people think, oh, multifamily is safe in a recession, right?
I remember, yes.
Right. That, and then, several years after, and people always forget this, the foreclosure crisis did not really peak until 2011, was it 2012?
Yeah, 2011, 12.
Yeah. So that was not, the Great Recession was over, right? We were in a recovery already. The worst was behind us, but the foreclosure crisis had this lag, and then all these people left their houses and they moved into apartments. So apartments looked really good. So then this other myth emerged, like multifamily does well in a recession, right? Also not true.
Correct.
Right? But because of those things, everybody was essentially took the position multifamily is risk-free. And I'm talking, it wasn't like just syndicators who did this. It was everybody on up through the biggest institutions out there who decided they all bought the same line. They all bought the same narrative. Multifamily is the safest thing out there. And essentially there's no risk attached to this asset. And we can just bid it up to the stratosphere and it'll all be fine. And because of that misperception of safety, the bubble blew up enormously, way, way, way bigger than the GFC. Now not for single family houses, but for specifically apartment buildings, because of this perception of safe. So as a result, there's for every action, there's an equal and opposite reaction. And the size of the bubble, the size of the crash tends to be exactly mirror the size of the bubble, right?
Correct.
So that means hard crash. That means big discounts. That means
it's going to be fun.
Opportunity.
Yeah, it's going to be fun. It's really comical to me about all of this, and I think we've talked about this before, but I see the commercial pain as a mirror to the GFC and residential pain. Why? Short-term debt, variable rate debt, assumptions that prices only go up, stupid assumptions, new money, new grifters, new pretenders. It's all the same stuff. I remember the craziness of people saying single families only go up. I'm like, are you guys kidding me? What the hell? And then I got out of the way and it crashed. And we saw the same thing in multifamily, but the bubble's bigger, right? There's an extra 0 or 2 on these deals. Exactly. So it's going to be crazy. Jonathan, where can people find you?
Well, come to my school group. A bunch of ORaaT people have already come to my school group. It's really great. Yeah, I'm really happy to see you. The group has a free level. So just go to school.com/AIC. And what I'm doing is I'm getting on the phone with every single person who joins the group.
Wow.
So if you would like to have a 22-minute one-on-one with me,
22 minutes.
22 minutes. I picked that number because everyone says 20 minutes or 30 minutes. I want to do
22. I like it.
So 22 minutes. My goal in the 22 minutes is to either solve the biggest obstacle you have in multifamily or answer the biggest question that you've got.
Beautiful.
And in return for that, I just want to know how I can make my group more helpful to you. So not pitching anything, just want to get to know you. So if you'd like to jump on the phone with me, join my school group and schedule a call.
Awesome. Thank you, buddy. Take care. Have a good week.